A trader who is wrong 60% of the time can end the year with more money than a trader who is right 70% of the time. Same market, same starting capital. The one who loses more often wins. That is not a trick of words, it is arithmetic, and once you see it, you cannot unsee it. Quick note before we go further, this is educational commentary, not personalized financial advice. I'm going to show you the mechanism and let you decide how it applies to your own process. Here is the belief almost every retail trader carries without questioning it. They think trading is about being right. So they hunt for the setup with the highest win rate, they screenshot their green days, and they feel physical pain when a trade goes red. Their entire self-image is tied to accuracy, and that instinct feels obviously correct. Of course, being right more often is better, except in trading it simply is not, and the people who understand that are quietly taking money from the people who don't. Let's prove it on the simplest possible case. Two traders, $100 each and 10 trades. Trader A is our accuracy king. He wins 7 out of 10 trades. But he is terrified of losing, so he takes profit fast plus $10 per winner, and when he's wrong, he freezes and hopes, losing $30. Trader B wins only 4 out of 10. But when she's right, she lets it run for plus 50, and when she's wrong, she cuts it hard at minus 10. Watch what happens. Trader A, 7 wins times $10 is plus 70. 3 losses times $30 is minus 90. Net result, he is down $20 despite being right 70% of the time. Trader B, 4 wins times $50 is plus 200. 6 losses times $10 is minus 60. She is up $140 while being wrong more than half the time. The accurate trader lost money. The inaccurate one nearly doubled up. The number that actually pays you is not win rate. It is expected value. Expected value is your win rate times your average win minus your loss rate times your average loss. That single line is the whole game. For Trader A, it's 0.7 times 10 minus 0.3 times 30, that's negative $2 per trade. For Trader B, it's 0.4 times 50 minus 0.6 times 10, positive $14 per trade. Being right is one term in the equation. It is not the equation. Now flip the question around, because this is where it gets useful. If your average winner is 3 times the size of your average loser, what win rate do you actually need just to break even? The answer is 25%. Win 1 in 4, lose 3 in 4, and you're flat. Anything above that, and you make money being wrong 75% of the time. This is the break-even win rate, and every trader should have it tattooed somewhere visible. Here is the table that reframes everything. At a 1-to-1 payoff, you need to win more than half your trades. That's the hamster wheel most retail traders are stuck on. At 2-to-1, break-even drops to 33%. At 3-to-1, 25%. At 5-to-1, under 17%. The bigger your winners are relative to your losers, the more often you're allowed to be flat-out wrong. Accuracy and payoff are 2 dials, and retail traders spend all their energy cranking the wrong one. So why is everyone obsessed with being right? Because of how it feels. A string of small wins gives you a steady drip of dopamine and a story that you're good at this. A big winner interrupted by 6 paper cuts feels like failure, even when the math says you're crushing it. Cutting winners early feels safe. Holding losers feels like conviction. Every emotional instinct you have points you toward a high win rate and a negative expected value. The market is a machine for punishing people who trade their feelings. But expected value alone isn't the finish line, because a positive edge you bet too big will still bankrupt you. This is where position sizing turns math into survival. Say you risk 2% of your account per trade and you're wrong 6 times in a row, a completely normal streak at a 40% win rate. You're down about 11%, uncomfortable but alive. Now risk 20% per trade with that same edge, hit the same losing streak, and you've lost most of your account before the edge ever shows up. This is exactly why options traders think in asymmetry. When you buy a defined risk position, your maximum loss is the premium you paid, but your upside can be several times that. You are deliberately building 3-to-1, 5-to-1, 10-to-1 payoff structures, which means you can be wrong most of the time and still be net positive, as long as you size each bet so no single loss can take you out. The structure does the heavy lifting. Your job is to keep showing up with the same edge, small enough to survive variance. One honest caveat, because this channel is signal, not hype. A low win rate means longer losing streaks, deeper drawdowns, and more chances to quit right before the fat winner that makes your month. A 40% strategy can lose 8, 9, 10 in a row and still be perfectly healthy. Most traders don't fail because their math is wrong. They fail because they abandon a winning system during the drawdown it was always going to have. The edge only pays the people who stay in their seat. So what does a disciplined trader actually do with this? Three things. First, they stop measuring themselves by win rate and start tracking expected value per trade. Second, they define the exit before they enter. The loss is capped. The winner is allowed to run, so the payoff ratio is engineered, not hoped for. Third, they size every position so a losing streak is boring, not fatal. Being right becomes almost irrelevant. Being paid becomes the only scoreboard. Here's the line to keep at your screen. You are paid by expected value, not by being right. The next time you feel the urge to snatch a small profit or hold a losing trade to protect your ego, ask which dial you're actually turning. This same logic runs everything from venture investing to poker to running a business. A few large asymmetric winners carrying a pile of small, controlled losses. If that reframed how you see your own trading, subscribe. We break down the market's math without the hype. Trade the expected value. Let the win rate be whatever it wants to be.